Welcome to the Down to Finance Australia Future Finance Group podcast. Today, going to be talking about one of my favourite topics, myths in lending. We've got two of our mortgage brokers here, Sarah Bryden. Welcome, Sarah.
Hello, thank you.
And Mandy Evans. Welcome, Mandy.
Thanks for having us.
All right, myths, exciting. Going to get straight into it. This is the absolute most common one. PAYG income. How long do you have to be employed for before you can go for a loan?
So if it's a permanent employment, so full-time or part-time, we will only need one payslip.
One payslip.
One
Myth
payslip.
busted.
So you, could have, be returning to work or starting a new job. One payslip. That is it. We don't need 6 months. We don't need 3 months, as long as you are permanent, part-time or full-time.
Yep. So it's permanent, part-time. There is no such thing as
waiting
permanent
3 months. There is no
casual,
need to wait for
permanent, casual, just permanent.
Just permanent part-time.
That's right.
Or full-time.
Correct.
Correct.
Yep. All right. Probation. Can you get a loan on probation?
Absolutely.
Not the jail type. I'm talking about employment type.
Yeah, definitely. This is one that actually a lot of people ask. They always think that they need to wait until their probation period has been served, but no, you can actually get it while you're on probation. It does depend on the lender, but yeah, it's possible.
Good one. Now, casual.
Casual. So with casual employment, across the board, it's 6 months. So we need to be able to demonstrate to the lender the income that you've received over 6 months, and then that would be annualised out over the 12-month period.
To show that consistency.
To show that, it's consistent. Because obviously with casual employment, like 1 week you could be working 6 hours and then the next week you're getting 36 hours. So we need to be able to show them, 6 months of consistent employment, and we can use that year-to-date figure that's on your payslip, and then we, annualise that one out.
Perfect.
Yeah, so generally speaking, 6 months.
Yeah.
It does. Yeah, I was going to say it just does depend on the lender as well with those as well, and the way that we present it to the lender. It's really important that obviously our broker notes and things like that we're giving them a really great story, so that they can understand where that income's coming from and what will be ongoing.
Yeah, the key being the consistency.
Yes.
All right, myth busted. So if you are new to employment, you got one payslip, you can borrow. Fantastic.
Yeah.
All right, the next one. Deposits.
So when purchasing, depending if you're a first home buyer or not, you can buy your first house with as little as a 5% deposit.
Yeah.
And as of recently, whether it's a 5%, so if you're in that lender's mortgage insurance territory, we used to generally have to have shown what's called genuine savings. So it would need to be sitting in a bank account for a period of time, whether, depending on the lender, 1 month, 3 months.
Legitimate.
And, showing that you're
accumulating,
incrementing each, putting money in each week or fortnight or month. But majority of the major lenders or that are offering, say, these 5% schemes as well, then you can have it put in for 1 day with some lenders.
So you can get a gift from parents.
And you can definitely get a gift.
Parents, if there's you want your kids out, 5%.
Yeah. That's no problem. There is lenders out there where there's no time constraints either. We're having to show that it's been in the account for a period of time.
Yeah.
Which is a big win, so that you can jump straight into the market, not having to wait for that to tick over.
Yeah. What else can be evidenced as genuine savings?
Rental ledgers can.
Rental ledgers.
Yeah. So if someone has, they're paying rent rather than saving their money, then we can use the historical rent that they're paying as genuine savings to prove to a lender that they can afford the loan.
Add up to the value of 5%.
So you might only have, say, $20,000 saved. But we can show that over the last, 1 to 2 years, you guys have been renting and paying, $2,000 a month or whatever the figure is. And then that can show the genuine savings for the remaining.
Yeah. And then get the remainder as a gift from.
Correct. Yeah. So it wouldn't matter if that was just dumped into the account. Correct. Yeah. Yeah. So that's another good little myth. Busted.
The next one, HECS, help debts, for all those arts degrees out there.
Yeah.
So there's new schemes now where, or not schemes, but bank policies where they're not necessarily treating it as a liability. There are some lenders out there, depending on the value or the amount that you owe in
The HECS debt owing.
on your HECS debt, that can actually be removed somewhat, which will increase your borrowing
Gets
capacity.
excluded as a liability.
Exactly right. Yeah. So that's a huge win for all of our uni goers out
It can
there.
massively affect the borrowing capacity
Huge.
when
I had
HECS
one the
debts
other
comes
day. It
into
was
play.
like $80,000 difference in borrowing capacity.
Yeah.
So
Insane.
that's a good one as well.
Yep. So if you pay $500 a month, let's say round figure, towards your HECS, lenders will now exclude that. The reason why they're doing that is because obviously there's only a couple of years potentially left on that HECS loan. A bank loan's 30 years, so they use their due diligence to remove that and not punish for having a degree.
Yeah.
Correct.
Good one. Conduct, credit checks, credit scores.
Great question.
So if you've got a low credit score, does that rule you out from getting a loan?
It depends on the circumstances. So but not always.
Elaborate.
So we've had clients where they have been poor conduct, as we call it, or late payments on a credit card or something along those lines. And there are some lenders that will still look at those applications. Really does depend on the conduct and the reason behind them making those late payments. If we're able to present a really good case to a lender and explain the circumstances or explain if maybe something was to happen like a life event and if that occurred to that's a reason that there was that late payment, we can sometimes get that across the line.
Case by case?
Definitely case by case. Yeah.
Definitely case by case, but I would say that it doesn't necessarily completely rule you out.
Yeah.
Like there's lenders out there that won't credit score at all. They're the lenders that you're probably going to pay a little bit more in your interest rate and things like that. But it's still definitely something that you can work through.
Yeah.
I think as well. And there's lots of ways that we can do that, whether we're referring down to credit negotiators and things like that. So sometimes we can actually aid in having it removed or sorted, and then it's not a worry at all because your credit report has improved.
Yep. I recently had a client who was 4 months late on the credit card.
Wow, yeah.
And that appeared on his credit report as a red 4 showing 4 months late, so can't hide it. Open banking, the banks can see that it's been late. It was only a $2,000 credit card limit. He didn't have it on his internet banking, and it was the monthly fee that sort of kept getting charged and put him into the red. One of the big 4 were happy to take it on as a very strong profile client, and he hadn't been using the credit card either, and he had significant sort of savings in one of his accounts to cover that $2,000, if needed, and approved straight through because it's pretty pragmatic.
So it can definitely be the
sort of be done, but
storyline.
very sort of, case by case.
Absolutely.
The strength of the application and all the other components that come into play.
But a bad credit score or late on some facilities, not that it's great, doesn't rule you out from borrowing.
No, it's still definitely something worth looking into and working out a bit of a game plan for sure.
Maternity leave.
Good question.
If you're on maternity leave or going on maternity leave, can you borrow?
Yes, you can. There are quite a few lenders that will still allow you to borrow while on maternity leave. Most of them will require like a return to work letter or some form of letter that indicates the type of role that you're going back to. Is it full-time, part-time, and the sort of income that you're going back. And the wording on that letter is really important as well. Providing those letters to the lender, we can generally get it across the line, depending on the lender. But yeah.
Yep. Excellent. Sarah, anything to add on the maternity leave side of things?
Most lenders will look at what the shortfall amount is, not including your income. So let's say I'm on maternity leave and when we remove my income out, let's say the deal fails by $2,000 per month, and I'm not returning back to work for another 6 months, then, you know, they're going to want to see that you've got $12,000 in an account to cover your shortfall throughout that period of the time. So, we do them quite a lot.
I think the important thing with maternity leave is to get in touch with the broker very, very early to make sure you sort of, you know, set up the application for success or come up with a good pathway forward for the maternity leave plan.
Leading up to that.
So
definitely.
you can work out the savings coverage and all those sorts of things. The last one, I like this one. It's a very, very good policy. If you're a single parent, can you get a loan with just 2% deposit?
Yeah, there is the family guarantee scheme that does allow that. Single parents can have a 2% deposit and borrow the remaining 98% without paying lender's mortgage insurance.
Yeah, it's a great scheme. And it can be
for second home buyers as well.
Yes, so
you don't have to be a first home buyer, which is nice. So you may have bought with, you know, your ex-partner and that relationship's dissolved for whatever reason, and the single parent can go and buy with a very small deposit.
And one thing with the 2% family home guarantee scheme as well is that mum and dad, you don't have to have full custody of the child. So even if you've got 50%, that still allows you to qualify for it.
It's a good one.
And even if you are sort of going through the separation process and your current home may not have sold, if that is the case, as long as that home is sold by settlement of the new property, that's okay as well. So
and in some cases the child support agreement will be taken into consideration as well for potential income. So
it's a really good one for people to be able to stay in the market and not have to move into that sort of rental space. So I love that one.
There's a goodie. Well, that wraps up. It's a quick podcast, but that was our 5 myths that we wanted to bust today. So if you've got any questions about any of those, please reach out. And that wraps up our Down to Finance Australia Future Finance Group Mythbuster podcast. Thank you for listening.
Thank you.
Just remember to keep in mind, these podcasts are just general advice. And if you are after something more customised, reach out to your financial advisor, or you can reach out to us and we'd be more than happy to help.